Happy Thursday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Thursday, December 14th, 2023. As always, we'll start with the executive summary from today's leadoff morning note. If you would like the analysis supporting these conclusions, as well as what to specifically do about them in your portfolio, you need to be a client of 42 Macro. So let's start with number one. Money markets are aggressively celebrating yesterday's dovish Fed pivot. This pricing is now a key market risk if the preponderance of economic data stops supporting the consensus soft landing expectation and start supporting the no landing scenario instead. Today's retail sales data was a good report for the U.S. consumer, but not so good that it supported the no landing scenario. Number two, the ECB and BOE, Bank of England, both stood pat on rates and signaled a more hawkish policy stance than their U.S. central banking counterpart, paving the way for a continued decline in the U.S. dollar over the medium term. A persistent bearish VAM's U.S. dollar is likely to perpetuate the uptrend in global liquidity our macro weather model signaled nearly a month ago when the composite signals for the stock market, bond market, and Bitcoin each transitioned to bullish. All told, we continue to see a clear runway for the Goldilocks top-down market regime to persist over the medium term. Much less so over the very near term, however, as a few of our quantitative risk management signals imply elevated risk of a pullback in stocks. We expect any dip to be manageable and quickly gobbled up by underinvested, underperforming investors that have unnecessarily pigeonholed themselves into either the no or hard landing camps. Transitioning to our 42 macro dashboard here, we have a bevy of actionable signals generated by our friends over at Longbow in terms of the trading ranges, so definitely pay attention. So we have a tremendous oversold signal in the dollar. The dollar bounces, obviously, that's generally a risk-off type event, so be aware of that. We have an oversold signal in the 2-year nominal treasury yield. We also have an oversold signal in the 10-year nominal treasury yield. We have an oversold signal in the 10-year TIPS yield as well. We have an overbought signal in the S&P 500. We got an overbought, I'll keep moving here. We got a overbought signal here in the Russell 2000 as well. And so there's a lot of, and then we got an overbought signal here in base metals. So there's a lot of, this is not a great chase to be, this is not a great place set up in asset markets from a short-term risk management perspective to be betting on Goldilocks, in terms of being late to that party or to be trying to position for a soft landing. Because again, you're late to the party. The time to pivot and position for these things was when our quantitative risk management signals started to, increase our risk management, our exposure to, the equity, credit, and crypto markets, well over a month ago in certain respects. So we'll transition to our 42 macro aware community. We had a question here about the bear party. So I want to say the question reads, you've used the expression, the party is just best before the cops show up, referring to our studies of an all-out rally preceding hard stops or hard landings in the economy. How would you rate this party at the moment? The answer is it's obviously a great party. So obviously the markets have been rip-roaring rallying since we called for that pay and trade higher in stocks and bonds at the beginning of November. But what I think is just as important is that rally is accelerating too. I mean, even if you bought stocks, just looking at the return of the S&P 500 on a month-over-month basis, the S&P is up 5% on a month-over-month basis. And a month ago, that was the big up day on the October CPI report. So we're at 5% from that big up day. So there's plenty of opportunity for investors to respond to the evolution of our quantitative risk management signals. Obviously, if you're not paying for the quantitative risk management signals, you would not have seen the top-down and bottom-up risk management overlay pivots in our KISS process, nor would you have been able to react to them as a discretionary investor. So in terms of specifically answering the question, how would we rate this party? It's a fantastic party. And the parties, as we've talked about in lead-off morning notes for almost a month now, is the party is being driven by legitimate fundamental reasons, things like the improvement in productivity, the immaculate disinflation, the immaculate loosening in the labor market. Like a lot of things are happening that are very positive. When will these things stop happening? I don't know the answer to that, but I know that we're probably going to be better served, relying on our, signals like our global macro risk matrix, our macro weather model, our volatility adjusted momentum signal in terms of, repositioning for when those things stop being true, as opposed to trying to guess when those things stop being true, which is what the preponderance of investors are out there doing, obviously with very poor results. So we'll wrap it up there. Darius Dale presenting our macro minute for December 14th, 2023. Best of luck out there. We'll catch you back here tomorrow. Same time. Cheers.